Goldman Sachs just quantified something your realtor will never say out loud. 80% of American homeowners are now locked into a mortgage rate below where the market is trading today. Sales are 22% below 2019 levels. Prices just set an all-time high. From the outside, that sounds like a market that's frozen solid, until you realize the country is actually split into two entirely different housing markets. One where the freeze is broken, prices are falling, and inventory is climbing back above pre-pandemic levels. That's happening in a specific list of states Goldman just identified. And one where inventory is still tighter than 2019 and prices are firming to records. That's a different set of states entirely. In this video, I'm going to show you which side of that split your zip code is sitting on, why it's happening now, and what it means for the equity in your home over the next 12 months. Stick with us. Let me start unpacking what Goldman actually published, because the details matter more than the headline. The Goldman Sachs mid-year 2026 housing outlook projects annualized existing home sales of 4.2 million for the second half of this year. That's a small 3% improvement over where we started 2026. It's also 22% below the pace we ran in 2019. The last year anyone still calls a normal housing market. Goldman Sachs is telling institutional clients that the second half of 2026 will still run at what they describe as the tail end of a multi-year freeze. And their chief economist is not expecting a Federal Reserve rate cut in 2026. In fact, Goldman flags a rate hike as more probable at the September FOMC meeting than a cut. Mortgage rates are expected to stay in the mid-6% range through the rest of the year. Now, hold that in your head. Sales frozen, rates staying elevated, Fed possibly hiking, and look at what the National Association of Realtors reported last month. Median existing home price in June 2026, $446,400. All-time high. 35 consecutive months of year-over-year price gains. That is the tension. Sales pace at the lowest level in 3.5 decades relative to the size of our population, while prices set fresh records almost every month. And here's the number that ties it together. Nearly 80% of American homeowners with mortgages hold a rate below current market. Nearly 60% hold a rate at least 2 percentage points below. That means when they sell, they don't just give up their house, they give up hundreds of dollars a month in payment savings they can never rebuild at today's rates. So they don't sell. Inventory stays tight, prices don't correct, the market freezes. This has been the story for 4 years now, but Goldman Sachs' new outlook is flagging something different starting to happen underneath the surface. Here's where the map splits. JP Morgan Private Bank released their own analysis a few weeks before Goldman, and they built something called the Thawing Index, a proprietary metric that combines sales activity, inventory rebuild, and price movement across the top 100 metros in the country. The results are stark. The markets breaking out of the freeze are concentrated in a specific corridor: Texas, Florida, Louisiana, parts of Colorado, the Pacific Northwest. In these states, inventory has climbed back above pre-pandemic 2019 levels. Prices are already falling from 2022 peaks, and sales activity is actually picking up as buyers step into softer pricing. Zillow's own 12-month forecast confirms it. Between January 2026 and January 2027, Zillow projects the biggest home price declines in the country will occur in, I'll give you the list: Houma, Louisiana, down 6.5%, Lake Charles, Louisiana, down 5.6%, New Orleans, down 4.1%, Austin, Texas, down 2.9%, San Antonio, down 2%, Boulder, Colorado, down 2%, Punta Gorda, Florida, down 2%, Denver, down 1.9%. 6 of the 15 biggest projected declines in the entire country are in the state of Louisiana alone. 5 more are in Texas. That is a geographic concentration you can't ignore. Now, flip the map. Zillow projects the biggest home price increases over the same window will occur in Rockford, Illinois, up 5.4%, Atlantic City, New Jersey, up 4.8%, Syracuse, up 4.4%, Knoxville, Tennessee, up 4.3%, Hartford, Connecticut, up 4.1%, Green Bay, Wisconsin, go Pack Go, up 4%, Wisconsin, Connecticut, upstate New York, New Hampshire, Pennsylvania. The entire top 15 list of appreciation leaders is Midwest and Northeast metros. Bright MLS's 2026 forecast, released in December, calls the same divide. Their chief economist, Lisa Sturtevant, said on the record that 2026 will be, quote, one of the most geographically divided markets we've seen in years. Their forecast calls for cooling in Florida, Texas, Seattle, Portland, and Denver, and stronger price growth across the Midwest and Northeast. And Intercontinental Exchange Mortgage Technology's April 2026 Mortgage Monitor puts hard numbers on the inventory side. 40% of U.S. markets are now at or above pre-pandemic supply, with the strongest gains in the Mountain West and parts of the South, while deep inventory deficits still persist across much of the Northeast. Realtor.com reports Denver inventory is 100% above 2017 to 2019 norms. Austin 69% above. Seattle 60.9% above. Those numbers alone tell you the entire freeze narrative doesn't apply everywhere. So drop your state in the comments right now. We want to see this map form live in the comment section as this video circulates, because the split we just described is the single most important thing to understand about the 2026 housing market. And most local coverage isn't giving it to you in these terms. And are you ready? But wait, it gets worse for anyone hoping the freeze half of the country is about to catch up. Intercontinental Exchange Mortgage Technology published research quantifying just how sticky the lock-in effect actually is. They're finding for every 1 percentage point spread between current market mortgage rates and a homeowner's existing rate, the probability that homeowner sells drops by 18.1%. Andy Walden, who runs mortgage and housing market research at Intercontinental Exchange Mortgage Technology, put it on the record. The housing market continues to be defined by the lock-in effect. Now, think about what that means at scale. The largest concentration of outstanding 30-year conforming mortgages in America right now sits in the 2.5% to 3.5% rate bucket, per JP Morgan data. Current market rate is 6.41%. That's a spread of roughly 3 to 4 percentage points for tens of millions of homeowners. Do the math on the 18.1% probability drop. For most of these owners, the probability of selling in any given year has been cut by more than half compared to a normal market. And it's not just interest. Homeowners are actively working around it. Intercontinental Exchange Mortgage Technology reported that in the first quarter of 2026 alone, homeowners pulled $47 billion in equity out of their homes, the highest first quarter total since 2021. They did it through second lien loans and HELOCs, not by selling. 3.9 million homeowners with 2020 to 2022 primary mortgages are now sitting on both their sub 4% first mortgage and a second lien on top. That is behavioral evidence, hard data, that the lock-in isn't unwinding, it's mutating. People are figuring out how to extract cash without even giving up the rate. And the second lien volume Intercontinental Exchange Mortgage Technology recorded in the first quarter of 2026 was the strongest first quarter reading in almost 20 years. Let me put a homeowner level number on this. If you have a $400,000 mortgage at 3% and you'd have to refinance into a 6.5% market rate to buy a comparable home today, your monthly principal and interest jumps from roughly $1,686 to $2,528. That's an extra $842 a month, over $10,000 a year for the same house. Multiply that gap across tens of millions of homeowners, and you understand why the freeze isn't breaking through voluntary listings anywhere. The underlying market isn't already softening. In the states where inventory is still tight, Northeast, Midwest, coastal California, the freeze isn't going to break through natural seller flow anytime in 2026 or probably 2027. Goldman Sachs' own forecast doesn't project existing home sales returning to 5 million a year, pre-pandemic norm, until 2027 at the earliest. Here's the historical anchor that makes all of this hit differently. JP Morgan Private Bank published a chart that should reframe how you think about every housing headline you've read this year. They measured total U.S. home sales, new plus existing, relative to the size of the household population. Not raw sales, not headlines, the share of American households actually transacting. The ratio peaked around 7% in the mid-2000s. It dropped to about 4 to 5% throughout the 2010s. Since 2021, it's collapsed to roughly 3 to 3.5%. That is a lower share of Americans buying and selling homes than at any point in the aftermath of the 2008 Great Financial Crisis. Read that back. We are, by the most honest measure of market activity, in a deeper transaction freeze than the aftermath of the worst housing crash in modern American history. Goldman Sachs called this out back in 2023, too, flagging that existing home sales had already fallen to the lowest level since the early 1990s. And Cotality, formerly CoreLogic, Case-Shiller confirms the top of the price cycle is thinning out. The March 2026 20-city composite reading came in at just 0.8% year over year, the smallest annual price gain since July 2023. So here's the controversial take that most real estate coverage will refuse to put in these terms. This isn't a housing correction. This isn't a rate problem that gets solved when the Federal Reserve cuts. This is a structural affordability crisis where the median American household cannot afford the median American home at any interest rate the Fed is realistically going to deliver in 2026 or 27. Zillow data shows U.S. income growth is running around 3.6%, while home prices are up only 0.2% year over year, which is the good news, but affordability is healing at a pace of maybe 3 percentage points a year against a gap that opened up 40-plus percentage points wide since 2020. That takes years, not months. And it explains why the freeze is only breaking in specific states, the ones where prices overshot hardest in 2020 to 2022 and are now correcting first, while the rest of the map is in a slow grind. So, what does this mean for you specifically? If you own a home in Texas, Florida, Louisiana, Colorado, Seattle, Portland, or the wider Sun Belt, your equity peak may already be behind you. The freeze in your state is breaking through falling prices, which is good news for local affordability, but bad news for anyone planning to sell in 2026. If you're considering listing, get in front of the price cuts, not behind them. If you own in the Midwest, Northeast, or coastal California, your equity is likely to keep firming into 2027, but liquidity is going to stay thin. You can hold, but if you want to sell and relocate, expect the buyer pool to be narrower than the price appreciation suggests. If you're a buyer in a freeze-breaking state, this is the first genuine leverage buyers have had in 4 years. Inventory is above pre-pandemic in metros like Denver, Austin, and Seattle. Sellers are cutting prices. Use it. If you're a buyer in the still frozen half of the country, expect competition, expect firming prices, and understand that the affordability window opening in other states is closing on you. And if you're a seller in a Sunbelt metro right now watching your listing sit, price cuts are increasingly required to move product. Sitting on aspirational pricing in a market with rising inventory and softening comps is a losing strategy in 2026. This is the map Goldman Sachs is telling institutional clients to underwrite. Now you have it too. Subscribe and hit the notification bell so the next video lands in your feed the moment it drops. And watch this one next. We'll see you next time.